Hello and welcome to IIFL Markets. Today, we bring you our expectations from the automobile sector for the fourth quarter of the year. Amid strong sales in most segments, automobile sector is well poised for a good quarter. Part of this performance will be driven by a low base in the March 2020 quarter, which was impacted by a nationwide lockdown which was induced by the pandemic. Buses and three-wheelers, though, will continue to struggle in the quarter. Sharp rise in input costs on a sequential basis could impact EBITDA margins. Though most OEMs announced price hikes in the month of January and April, these may not be enough to fully offset the increase in input costs. Margin contraction is likely to be sharper in the case of two-wheelers and tractors, as these segments have seen sequential fall in volumes. Let us look at individual companies now. Maruti Suzuki. Healthy volume growth on sustained demand and low stock levels will be a highlight of Maruti's results. Margins, though, are likely to come off on a sequential basis due to rise in commodity prices. Price hikes announced in January 2021 were effective only in the month of February 2021. Net profit growth could be hit due to lower investment income. M&M. Volumes have grown on a YY basis due to a low base, but on a sequential basis, they are down, indicating continued pressure. EBITDA margin is likely to contract on a sequential basis with higher input costs and negative operating leverage. Auto EBIT margin is estimated at 6%, while tractor EBIT margin is pegged at 21%. Tata Motors. On a consolidated basis, we expect sharp improvement in the net profit both on a sequential and year-on basis. This is due to a better operating performance of JLR as well as the standalone entity. Let us look at each of them separately. JLR. JLR volumes ex-China JV grew 2% on a YY basis and 20% sequentially. The EBITDA margin could contract due to normalization of mix, pricing, and costs. We expect positive FCFF in the quarter, which is in line with the seasonality factor. Standalone business is likely to witness strong volume growth both on a YY basis and sequentially. Passenger vehicle segment continued its healthy growth momentum in the quarter, and what's more, the CVs also recovered from the lows. We expect margin to improve and losses to come off, driven by strong operating leverage, turnaround in the passenger vehicle business, and sustained cost-cutting efforts. Ashok Leyland. M&HCV volumes have grown at a strong pace both on a sequential and YOY basis. This is in sync with the recovery in the CV cycle. Gross margins could come off due to input costs, but the strong operating leverage will drive expansion in EBITDA margin. Hero MotoCorp. The volumes have grown by 18% on a YY basis due to a COVID-hit low base, but are down 15% sequentially. The company has taken price hike of 1.5% in January, but this will not be enough and will fall short in meeting input cost pressures. The margin is likely to contract sequentially due to sharp rise in commodity prices and negative operating leverage. Bajaj Auto. The volumes have grown by 18% on a YY basis, but are down 11% sequentially. Segment mix is favorable on a sequential basis, with a drop in the share of lower margin domestic two-wheeler business. Expect margins to contract sequentially due to higher input costs and negative operating leverage. Better revenue mix to partly offset this margin pressure. We expect 19% YOY EBITDA growth, but PAT growth is likely to be impacted by lower investment income. TVS Motor. Volumes have grown 47% on a YOY basis, but fell 66% sequentially. The segment mix is favorable on a sequential basis, with drop in revenue share of mopeds which have low average selling prices. Price hikes of 2% were taken in Jan by the company, but are unlikely to completely offset the input cost pressures. We expect margin to contract 45 basis points sequentially, with input cost pressures offset by mixed benefit. Thanks for tuning in. If you like this video, subscribe to IIFL Markets.